Okay, good day everyone. This is Capitaland Ascendas REIT first quarter 2024 business update dated 22nd April 2024. Right, so we'll look at the key highlights. They divested 3 properties in Australia. We'll talk about this in a moment. Aggregate leverage is up slightly, but it looks still manageable, below 40%. Right, please note this does not include their perpetual securities. Right, high level of natural hedge. This one I won't talk too much about. Okay, portfolio occupancy, there's a slight dip, and you'll see later that the dip is across all the countries they are spread over. Okay, rental revision is actually not 16.9%, right? They made a correction in a later post, right? So instead of 16.9% positive rental revision, it should be positive 16%, right? Still good. Okay, we look at the divestment. Okay, they divested their property at 73 million Australian dollars, right? When the valuation is at 68.75 million Australian dollars. So it's 6.2% above valuation, right? Given that the NAV of the REIT, I didn't take it from this presentation. I took it from the last quarter's presentation. NAV is something like 2.26. All right. So if we assume that they can divest everything at 6.2% above valuation, I will estimate their fair value at $2.40. All right. So it's slightly expensive now. I think it's something like $2.65. All right. So yeah, I would only probably think about buying this REIT at 240 lah. Okay, but again, that's not financial advice. Right, so it's a good thing that they managed to divest above valuation, but I was hoping for more. Right, so balance sheet, aggregate leverage gone up slightly. That's not too bad, still manageable. Adjusted interest coverage ratio is 3.6 times. All right, so that's still quite healthy. All right, it's still healthily above 3, and you can see it's not very far from the interest coverage ratio of 3.7 times. Right, so this shows that their perpetual securities are not too significant, right? Because we look at this because this covers perpetual securities. All right, remember that this is probably not a very good representation because it doesn't include the perpetual securities, right? But it's still quite safe lah. This REIT, 3.6 times is still quite high, right? There are other REITs that are 3 and even below, right? So we look at also fixed rate debt as percentage of total debt. Okay, we are glad to see this high at 82.6%, higher than before. But we are not so happy to see that the average all-in debt cost has gone up to 3.8%. Right, later on we'll find out why this is always higher than other REITs like MLT, for example. Okay, debt profile, okay, is well spread out. Not going to object with that, right? Just that this year they have to deal with this amount of debt to be refinanced, and remains to be seen how much more they'll pay for their all-in debt costs. All right, so not going to go through all this because I don't think it's that important. All right, occupancy is a bit disappointing because across the board, Singapore is down 0.4%, United States is down 0.9%, Australia is down 2.1%, and UK and Europe is down 1.8%. So everywhere is down quarter on quarter. Right, so not a very healthy thing to see. Singapore is below 95%. I'm a little bit disappointed. Right, probably shows that there's some demand issues. Okay, so this is just after they included the latest investments. Right, so it'll go up slightly to 92.3%. Right, US is 89.5%. Right, disappointed again to see this go below 90%. Right, to me, if you have below 95% occupancy, I think there are some issues with the demand side. All right, that's my opinion. All right, Australia is still healthy, 96.6%. All right, United Kingdom, although it's still quite high, all right, but there was a single tenant lease expiry of a data center. All right, and so far I think they haven't managed to replace this tenant. All right, so the data center, I believe at this point is empty, right? So that's why 0%. Okay, let's move on. Okay, so you can see that generally rental, there aren't any revisions in the US, Australia, and the United Kingdom. Right, again, this is a mistake. They publish an note to remove this percentage. Right, this was, I believe they said, for a single tenant revision and not a multi-tenant revision. right? So they remove this, right? The correct version will be US has no renewals, and the logistics side has zero renewals as well, right? So but you can see SG Logistics, the renewal rates are quite high, right? So yeah, it looks like Singapore's logistics has demand, right? Probably it's the business part that is not doing so well. Okay, not going to go through this. Yeah, I'll try and go through the Q&A a little bit more because I think there are more interesting things to go through there. I don't think there's any much things that I want to discuss here. Yeah. Yeah, so they are saying that in Singapore they have higher than average occupancy across all metrics, but you can see the business space and life science space is not doing very well, right? This is dragging the Singapore performance. Okay, yeah, that's all for this, right? I'll go through the next part. Right here, they have some interesting Q&A following this quarterly business update, right? So they asked about the 11 data centers that was acquired in March 2021, right? They bought it for 904.5 million SGD, and then within 1 year, it dropped more than $150 million in terms of valuation to 728.5 million SGD, right? So they will question on this, right? So this management's answer that they said mainly they wanted data centers, and they appear to have a long-term plan for to acquire data centers, all right? So basically, they said that the main reason for the drop is due to the change in cap rates, right? So instead of at that point when they buy is 5.72, and then later on in FY 2022 is 6.69. All right, so that's why the valuation of the buildings dropped. All right, in case you don't know what cap rates are, all right, cap rates is actually a metric that takes the operating income, okay, the net operating income divided by the purchase price of the building, right? Generally, it's a measure to indicate how well a REIT generates income through the operation of a particular property, right? Higher cap rates indicate higher returns and higher perceived risks, right? So in this case, what is happening, right, is that the data centers got adjusted to a higher cap rate to reflect the higher risk in terms of the data centers, right? That means to say that there are concerns about data center occupancy lah. That's why the cap rate has gone up. All right, so it's not a good thing for cap rate to go up like that. All right, in this manner. Okay, so that's why the properties got devalued lower. Right, so what I did was based on the cap rates they discussed, right? So they are trying to defend themselves by saying that in FY 2023 the valuations has recovered, right? Because the cap rate has lowered, so perhaps the perceived risk has dropped, right? So I actually used the cap rate and the valuations to try and calculate the net operating income of the property, right? So I calculated net property income amount in when they bought to be 51.7 million. In FY 2022, it seemed to have dropped to 48.7 million. In FY 2023, it seemed to have dropped to 47.1 million. Right, so there's a trend of the net property income dropping. Right, so not a great thing lah. Okay, so there are other questions about these two properties. Right, again they talk about cap rates and how the cap rates are actually related to the interest rates lah. Okay. So this industrial property they say have been empty, right? But I'm not so worried about this because it's very small, because they say that this property I think is very highly specialized for the previous owner who was there for quite some time, right? But this property, although it's empty, is only 0.1% of the total assets. So that's the benefit of Ascendas lah. It's really big, right? Yeah. So you see the tenant leases it for a very long time. So they're finding hard to find someone to replace his property because of its specialized nature, right? So yeah, I don't think I will talk too much about the rest. Then we'll just talk a little bit about the annual report, right? So this annual report was published a little bit later, right? So they're trying to explain why some REITs have lower all-in cost of borrowing, right? Borrowing costs, right? And for example, MLT and MIT, I think we've discussed these two REITs quite in depth. Both of them have exposure to Japan, which has low interest rates, and MLT also has exposure to China, so they can borrow in that currency with low interest rates. Right, for Ascendas REIT, they focus on developed countries, so Europe, Australia, US, all right, and Singapore, and all of these places have high interest rates, right? So you can see Singapore is the lowest at 4%. Europe, Australia, and US is 5 to 6%. That's why their interest rates is quite high and probably projected to go higher. The only thing they can do is slow the increase, all right, by trying to fix their debt rate, all right. So they are saying that they expect that if in the long run they will probably the weighted all-in cost of debt will reach 4 to 6%. Okay, because that's the current benchmark in the countries. That's assuming nothing changes in terms of interest rates around the world. Okay, so that is a concern that we have to be aware of, right? So this is the Tampines Industrial Avenue 3. They say they're optimistic. Maybe they can find some tenants, right? Worst case, they'll just rebuild. Okay, they'll demolish and rebuild. Of course, not so good because then they have AEI problems. They have to spend money on AEI, right? Then the International Business Park, they are starting to redevelop, all right, and double the land plot, trying to connect it to MRT, and hopefully all these things will help improve the occupancy. Right. Yeah, they are saying that Singapore very hard to find data centers. This one we know already. Okay, and yeah, they will ask about whether the data centers are designed to take on AI, but I don't think the chairman's reply sheds a lot of light. They say the decision lies with the tenants, and they just provide the real estate infrastructure for the tenants to operate the data centers, right? And they assume that there's sufficient infrastructure to support AI workload. Okay, so not very insightful answer in my opinion. Yeah, so they have intends to, I think they have intends to expand beyond UK, right, in terms of data centers. So they want to buy more data centers, right? So they repeat their mandate that they want to stay in developed countries and they want to have exposure to US, all right? They say that the 11 data centers they acquired allow them to employ a good team to manage the data centers. I think the size is important, but whether or not a good team, they manage to get a good team or not is another question, right? I think you need to judge the team over a longer term. Right, so yeah, that's roughly all. I know there's not too much in terms of things like DPU for this update, but anyway, again, none of this that I've mentioned today is financial advice, and thank you for listening.